Most of us picture the stock market as a perfectly transparent ecosystem. You log into a brokerage account, punch in a ticker symbol, and see a real-time price reflecting every buyer and seller in the world, cleanly organized for anyone to see. This is the traditional model of a lit exchange. It operates as a public forum, like the New York Stock Exchange, where participants openly broadcast their intentions to buy and sell. That visibility creates a public record, which establishes a stock's actual price. But that blinking green and red ticker is not telling you the whole story. The public tape represents only a fraction of the actual shares changing hands globally. Modern finance has actually split into two distinct layers. There is the visible surface retail investors are allowed to trade on, and beneath it, a massive hidden reality. That shadow market is made up of private forums known as alternative trading systems. In the industry, they go by a more ominous name, dark pools. Today, dozens of these private networks command a substantial portion of all U.S. equity trading. Major financial institutions use them to quietly exchange billions of dollars in securities every single day. None of this liquidity is advertised to the general public. The true currents of global wealth are deliberately routed away from public exchanges so that average investors never see them coming. Why would major pension funds and asset managers go to such extraordinary lengths to keep their trades off the public books? The answer comes down to a financial penalty known as market impact. When you manage a multi-billion-dollar portfolio, you cannot simply buy 1 million shares of a company with a single click without severe consequences. This diagram illustrates how a massive block order interacts with a standard limit order book. If an institutional buy order hits this public record, it acts as a giant flashing beacon. Other traders instantly see the incoming demand and adjust their prices accordingly. The asset's price rapidly spikes away from the institutional buyer before their order can even fully execute. For an institutional whale, transparency is a severe financial liability. Broadcasting their intentions guarantees they will pay a higher price. Alternative trading systems solve this problem by eliminating the public limit order book entirely. When a massive block of equities enters a dark pool, there is no market depth feed. Neither the size of the trade nor the identity of the trader is revealed until long after the transaction is finalized and reported to the consolidated tape. This diagram shows two parallel price columns representing the public bid and ask from a lit exchange. To figure out a fair price without public bidding, dark pools use a mechanism called a midpoint cross. They reference the lit exchanges and secretly match a buyer and seller at the exact mathematical center between those two numbers. To further mask the true depth of their liquidity, institutions rely on an automated strategy called the Iceberg order. An iceberg order displays only a tiny peak volume to the market. When that small chunk is filled, the order instantly regenerates from a massive hidden reserve of shares, repeating the process over and over until the full position is quietly cleared. Stripping away the public order book, breaking massive trades into hidden slivers, institutions slide massive blocks of stock without ever alerting the broader market. This system was built to be an institutional safe haven, but modern algorithmic high-frequency traders have infiltrated it. These high-frequency firms deploy a predatory tactic called pinging. Their algorithms fire thousands of tiny, rapid-fire orders into dark pools, blindly searching the void. When one of those tiny orders connects with something, the algorithm instantly knows a hidden institutional whale is lurking in the dark. Dark pool operators face a heavy conflict of interest. Many accept payment for order flow, effectively granting predatory algorithms priority access to the very institutions trying to hide from them. A sophisticated ecosystem built exclusively to protect long-term investors from the public gaze has mutated into a highly lucrative feeding ground for algorithms. This two-tiered market creates a serious systemic risk for the rest of us, specifically regarding something called price discovery. If an asset is traded publicly, the constant tug-of-war between buyers and sellers gives us a highly accurate price. The regulatory fear is that as more volume migrates to off-market venues, the prices printed on the public lit exchanges lose their accuracy. Interestingly, some economic studies suggest the exact opposite. Because dark pools draw in massive, slow-moving institutional trades, they leave the lit exchanges to the faster, highly informed traders. In theory, this filters out the noise and actually concentrates price-relevant information on the public exchange. Regulators and academics remain deadlocked over this paradox. They cannot agree on whether market darkness is a fatal flaw draining the system of transparency or a necessary shield that keeps prices stable. While the debate continues at the top, the reality for everyday retail investors is stark. We are left executing trades on a public surface that does not reflect the total market. We cannot see the massive orders working right below the surface before they are executed. This places the general investing public at a severe structural and informational disadvantage. Because the deck is stacked so heavily toward opacity, the only remaining defense is a demand for radical transparency, refusing to reward conflicted venues with order flow and insisting on clear disclosures from the dark pool operators. The stock market has long ceased to be a single, fair town square. To survive in modern finance, you must recognize that the most critical movements of wealth are the ones you are explicitly not allowed to see.